Welcome back. My name is Chris Gosselin from Australian Fund Monitors. Earlier today, I had the opportunity to talk to Rodney Brott, joint CEO of DS Capital. I thought it would be a good opportunity to talk to Rodney about reporting season and how the fund has performed during reporting season, but more importantly, what his outlook was and what his thoughts were on the overall reporting season. Rodney, good to speak to you again. It's the end of reporting season. Can you give me an idea what your view has been on reporting season across the board, not only for the DS Capital Fund?
Sure. Well, thanks for having me, Chris. I appreciate it. We've enjoyed a very strong reporting season, but more broadly, reporting season's been characterised by a few themes. The obvious one being the inability of companies to really be able to give clear guidance because of the lockdowns that are happening, the unpredictability of when those lockdowns are going to end and how they're going to end. And that's obviously made it very, very difficult for companies to plan, particularly coming into the all-important, for a lot of the consumer-facing businesses, the all-important Christmas period. And it's made it very difficult to give any form of guidance.
So in the US, for instance, reporting season's been characterised by terrific, it's only quarterly reporting rather than our end of year reporting, but it's been characterised by, one of the strongest reporting seasons ever. And as far as earnings and earnings per share go and profitability per share, have you seen the same thing here where the results have actually been above expectations?
Look, we've certainly experienced that with a lot of our investments. We've been very fortunate. I think across the board, the results have been better than expected. Probably not as stronger beats as there were at the last half-year reporting season, but still reasonably good all the same. And there's been a significant increase in capital management, whether that be bigger than expected dividends or buybacks, etc. And there's going to be a fair amount of cash that's going to be returned to shareholders in one way or another over the next month or so.
And that's likely to support the market, do you think?
Well, in a continuing period of historically low interest rates, people that hold money are looking for ways to deploy it, and the stock market still offers the opportunity to invest in growth businesses and get better returns than leaving the money in the bank. Now, ultimately, it's still the age-old question: are investors correctly assessing the risk of taking the money out of the bank and putting it into investments in the stock market, etc. But thus far, if we have a look at the recent reporting season, there's a lot of companies that are doing very, very well, whether that be because they've got terrifically strong businesses, or those businesses have been the beneficiary of the current lockdown type environment.
When you talk about interest rates, there doesn't seem to be any imminent change in interest rates, either here or offshore. There's perhaps the potential that tapering is going to come in towards the end of the year, but even that's not definite. So it doesn't seem to be a change to the overall valuation process.
Look, that's probably correct. There was a lot of attention given to the Federal Reserve's comments very recently about when they would start the tapering. And, true to form, they didn't say they would, they didn't say they wouldn't. They've obviously got a vested interest in interest rates remaining low. And I'd have to agree with you, it doesn't appear like there's a lot of concrete evidence that would indicate that interest rates are going to be rising significantly anytime soon.
So it's always dangerous to say steady as she goes, because that's when things come back to bite you. But you're comfortable with the direction of the market, and more importantly, comfortable with the positioning of your portfolio.
Look, we're very comfortable with the positioning of our portfolio. We've just wrapped up reporting season, and in almost every case, the companies that we've invested in reported in line with our expectations or better. In some cases, guidance was a little softer, but we really put that down to the business management being conservative and being very realistic about the uncertainty of the current environment. But looking forward in terms of, market volatility, it's going to depend on the usual things like interest rates, like fears of inflation. And, generally speaking, over the shorter term, it's all about psychology and emotion and fear of missing out that's going to drive share prices. Over the longer term, it's going to, fall back, to the fundamentals of the underlying businesses. And we're, obviously quite happy about our portfolio structure at this stage. But it's a constant process of managing it and checking that what we're expecting is actually met by what's actually happening.
Well, Rodney, in the last 12 months, you've produced something like 35, 36% return, above the index and above your peer group. Are you expecting that to continue, or is that too much to ask, or just a difficult question to ask?
Look, we think it's too much to ask. It's obviously been, a very good environment for equities managers over the last 12 months. Interest rates remaining low is obviously helpful to valuations. But we're cautiously optimistic, and we'll continue to look for businesses, from the ground up that are good at what they do and growing their product or service offering into large markets and run by people that we're very happy to back. But I think it's a lot to ask to print another year of 30% plus returns. But I can tell you, we'll be trying.
We'll look forward to touching base in the not too distant future, and good luck for the rest of the year. Stay safe.
No problems. Thanks, Chris, and you too. Appreciate it.